Stocks are crashing again. The Nasdaq is down nearly 5%, and it is set to have its worst day out of all of this year. So stocks are tanking. It's been a brutal day after such an amazing green day in the markets yesterday. In this video, we're going to explain what might be causing this crazy reaction and basically what's going on right now in the market. So yesterday was the FOMC interest rate decision. The stock market loved the news initially. It blasted to the upside, and it was an amazing day, not only for the S&P 500, but many growth stocks out there. Today is the exact opposite. Like I said, stocks are tanking. We can see basically the entire market is red. Even the powerhouse companies like Microsoft and Apple are down close to 5%, and stocks like Nvidia are down around 7.5%. So really nothing has fundamentally changed from yesterday to today. All it is the market's perception. So for example, in terms of interest rate benchmarks and all that stuff, like, there is no new news. Really, the only major difference is that the interest rates are skyrocketing in terms of like treasury bonds and stuff like that, and I will show you what I mean right now. So if we head over to CNBC and we look at the US 10-year treasuries and we look at the US 30-year treasuries and basically any other rates, they are booming today. And basically what this means is people are selling these, I guess you could say, bonds off. In the stock market, when you sell off stocks, the stocks fall. But in the bond market, like anything when it has to do with interest rates or anything like that, when you sell off those assets, the rates actually go up. So basically what we're seeing right now is a lot of selling pressure in the bond market. We do know that the Fed will be unloading their balance sheet. On top of that, their target rate has been increasing, as we know from yesterday, but interest rates are popping up. And that is definitely scaring the markets right now. If we look at the 10-year Treasury Index, that's booming. It's up around 6% today, which is pretty big. If we look at other ETFs like TLT, this is down 3.5% today. When you see Treasury bond ETFs selling off, that means interest rates are going up. So basically, the only main difference / main news from today is that interest rates are really booming to the upside. So that's the main thing. I know a lot of investors tend to get spooked out when they hear of rising interest rates. I actually have an interesting chart right here from Reuters. We can see the stock performance as the Fed starts to hike. We can see initially that through rate hike cycles since 1994, initially a lot of stocks sell off in the first month when the Fed start to rise interest rates, but over time it ends up doing just fine. Tom and I talk about this quite a bit on the channel. For the most part, the stock market does pretty well when the interest rates rise, but it does hurt in the short term sometimes. I know that it kind of sucks when you see rates rising because it will slow down a lot of things, everything from, stock market valuation multiples to, the housing market to many other factors. But if you look at it in a different sense, if we did not have the Fed, start to come in here and raise interest rates, that can be very bad for the future. Because if inflation gets too out of control, that would be very bad. So while it hurts in the short term, it's good for the long term because we really do need to calm down this crazy inflation that we're seeing in the economy right now. Like I said earlier, though, basically all stocks are falling off, and I believe that it has to do with kind of like a snowball effect. For example, let's say if we look at the S&P 500 first. Of course, it was amazing yesterday, but let's say at market open, the S&P 500 started to sell off first, and maybe when it was down 1 or 2%, yeah, it was a pretty bad red day, but once it starts to sell off more, then you have short sellers coming in, and then you have people who own the SPY start to close out of their positions, and then that creates even more selling pressure, and then you have more short sellers coming in, and that causes the stock to fall even lower, and you have people who own the asset that start to sell off, which causes the market to go even lower. So what I believe the main thing going on right now is just that snowball effect, and a lot of it has to do with algorithmic trading as well. Nowadays, majority of the volume we see not only with the SPY, but many other stocks in the market are traded by computers. So a lot of times when you're actually buying and selling stocks or options, you're not always trading against real people. A lot of times you are trading against these giant institutions and all their algorithms and things like that. And there have been a couple instances in the past where these algorithms do mess up and they do cause very dramatic and volatile moves in the short term for the stock market. So keep that in mind. I think that's also playing a giant role. But the main thing to know is that there really wasn't anything that really changed from yesterday besides the fact that interest rates are booming up, which is very important, but we kind of already knew this, to be honest. So that's interesting. If you're looking for plays to capitalize off of this market or rising interest rates or falling stock prices, a lot of people tend to look at VXX. I have not been a huge fan of VXX lately due to the weird events that it has been having over the past month. There was kind of like a short squeeze on VXX on March 28th, and there was some other crazy movement the other day with it too. It's not really moving too well, so VXX is one route, but I would honestly, if you're looking to short the market, of course you could just short the market or you could buy puts, but there's also an inverse leveraged ETF called SPXS. Basically, SPXS does the exact opposite of the market and like 3 times the magnitude. For example, we can see the S&P 500 is down around 3.6% right now, while SPXS is up around 11% right now. So it's like 3 times and to the opposite direction. This is awesome for short-term trading, but you don't want to hold it over the long term because this ETF does decay because it is leveraged. So don't do that. Don't hold it over the long term. And the last thing is if you're looking to play rates continuing to rise, check out TLT. This is a pretty popular ETF. Basically, when TLT falls, that means interest rates are rising. TLT specifically follows the longer dated, I guess you could say, rates, especially like the 20-year treasuries and stuff like that. So keep that in mind. Overall, the stock market's been crazy. It's been a brutal and volatile week so far. We still do have a couple big earnings coming up, so be on the lookout for that. Besides that, thank you guys so much for watching, and hopefully this market pops back up.